listed off. Let me now connect with the management of Educomp. Mr. Sanjay Jain, Group Chief Executive Officer, joins us live from New Delhi. Sanjay, morning. Thank you for joining us. If I look at numbers, what you've reported for the quarter gone by, after quite a volatile period, numbers are strong. Is your Q4 number a telltale sign that things have now eventually improved for Educomp?
Yeah, good morning. Yes, indeed, the quarter 4 performance definitely indicates that the coming quarters would continue to be strong, given that the number of classrooms that we have done, given the average price per classroom that we have achieved in quarter 4, indicates very well for the coming quarters as well.
Sanjay, just looking forward, FY13 is likely to be a year of consolidation for you, or at least that's the indication that is being given to us by the management in the previous conversations. You were expecting a 25 to 30% growth in revenues, a likely improvement in margins of 150 to 200 basis points. Where are you expecting this growth to really come in from? And can you give us some color on the school learning, K-12 school and high learning solution segment as well?
Yeah, firstly, when we say that the current year and for the next 2 to 3 years we are going to focus on consolidation, what we imply here is that we have nearly closer to $900 million of capital employed, and 27% of this capital is actually into our smart class business and government business, and which gives us 75% of the total revenue. However, 73% of the capital employed at present is nearly giving about 25% of revenue. Therefore, we would be really focusing on how to make sure that from the remaining 70% or so, which gives 1/4 revenue, we extract more and more value. And that is where the consolidation focus would be on monetizing the assets to generate more return on capital employed. And at the same time, we would also take a dispassionate view that if there are some 1 or 2 assets which are really not going to add, relatively speaking, much value in the next 1 to 3 years, we might not be averse to letting them go and monetize them. The focus would be to make sure that the balance sheet size remains same and is gradually brought down so that we improve our return on capital employed. As far as the growth in expectation, the growth would be largely driven, number 1, from the classrooms growth, the smart class growth. This year we have grown 50% in terms of number of classrooms. We did about 40,000 plus as compared to 27,000 in the previous year. We expect the growth momentum in the number of smart class to go up. Secondly, in quarter 4, there has been a healthy trend that the average number of classrooms in a given school has also gone up, which means that on one hand, we are doing business by selling more smart class across schools and more smart class in a given school. And thirdly, the price in quarter 4 in terms of average price per smart class is better than quarter 3. Therefore, this growth in volumes is also going to be accompanied by a better price as well. That is where, number 1, the growth is going to come from. Secondly, the growth driver would be the fact that we have nearly about 70 schools, K-12 schools in various stages of operation, and nearly about 9% of these schools are actually in year 4 of their existence, generating about 49% operating margin.
Sanjay, that's
so we would
news.
really be now scaling up.
Sanjay, that's the good news.
Yeah,
the fact that business is looking okay. Okay, let me just ask you the bad news. The bad news are 2. Number 1, you have a fat interest outgo, and then there is a $110 million FCCB which is due for redemption in July, which is about 60 days. Given the way how rupee has cracked against the dollar, I'm sure you're thinking about it.
Yeah, firstly, I would really not term it as bad news. I would term it as challenges that we have to address. And yes, there is indeed $80 million plus if I take the interest. There is a $110 million potential payment in July, 3rd week of July. We are making serious efforts in that direction and feel very positive that we would have sufficient credit lines tied up well before the due date for payment. And secondly, it is indeed correct that our interest outgo has gone up, and there are 2 ways in which we are really going to address this. Firstly, it has to be a continuous effort for management to make sure that we get financing at far cheaper rate. Therefore, we would not be averse to exploring various avenues in this. Secondly, and very importantly, we need to look inward to squeeze the capital from the system. Our capex, if you observe, the capex that we did in 2011-12 is 40% down as compared to previous year, and quarter by quarter the capex has come down. Secondly, number of debtor days have come down by 15 days in quarter 4 over quarter 3. So therefore, a focus on capital employed, especially on working capital, would release relatively more cash from the system, and hence the dependence on external capital should come down. These, I believe, should be some initiatives which would be key focus areas to keep the interest cost under a check in the coming year.